Hello, everybody. Kirk Spano, Fundamental Trends and Margin of Safety Investing on May 7th, 2025. Once again, overlapping with a Fed day completely on accident. Looks like it's going to happen 3 or 4 times a year. And with me, I have Teresa and Scott Shooter Henderson, my top-notch, ridiculous savant technical analyst, who I'll be having walk me through a couple charts in about 15 minutes. Thought I wanted to talk about the Fed today, but really I don't. It was a boring Fed meeting. He tried to make it a boring Fed meeting. It was interesting that President Trump and Scott Bessent both gave quotes and some tweets or social media posts during the Fed speech or during the Fed press conference. That is weird to me. That screams that they are trying to take the attention off the Fed, which I don't know. It is becoming apparent to me that the administration is realizing how big of a bite they are taking with these tariff talks and the trade renegotiations. I think that they are starting to realize that they probably just jumped in kind of head first, splashing and kicking around, and they really pissed off some of the other people in the pool. So I am not the optimist when it comes to how these trade negotiations are going to go. I have talked to people in about a dozen countries now that I know, and they are all saying the same thing. You just watch. Everybody is going to wait out the United States. Everybody. Potential exception is India, because they have a lot to gain by cutting a deal with the United States. What is that? They can steal a lot of the manufacturing and production that China's been doing. So we will see what happens. However, I think the optimism about trade deals that a lot of people are throwing out there in the traders' narratives are probably wrong. And if there are deals, particularly with our allies, they're not going to be much different than the way things were before. So while there may be some political points, there probably isn't going to be a big change economically. And I'm not so sure that it'll even be that good for the market, because what we are learning is that countries around the world have been backing off on their U.S. Treasury purchases. And some countries are even saying, well, if you really want to put the screws to us, we own enough of your debt that we can put the screws to you. So maybe think a little harder about the way you're handling things. We'll get to that in just a moment. My latest Editor's Choice article up on Seeking Alpha, a list of reasons to sell stocks, was published this week. I encourage you to read it. I will put a link up when this is on YouTube. If you don't already have a Seeking Alpha premium membership, I encourage you to get it. They're running a Memorial Day special. And I think that a dose of reality about what is going on in the U.S. budgetary process and the treasury markets and really the debt markets across the United States is in order. Back in 2007, I gave seminars back when you actually did it live. And I was buying steak dinners and Italian dinners for a better part of a year. And I probably had 600 people come to see me, different investors. You know how many clients I got out of that? Three. Do you know why? Because the message in 2007 that I was giving was, we are in imminent danger of a credit crisis. And I had taken a long time in learning about that. I had to educate myself after hearing different people talk about a coming debt crisis in 2005 and 2006 and into 2007. And so I learned how everything was really working underneath, how the derivatives were working, how the hot money was moving, everything that was going on back with credit default swaps and everything else in 2006 and 7. And I remember a conversation I had with my friend who is a pretty big time real estate agent in Milwaukee. We were on his boat and he said something about his real estate investments. He had like 10 duplexes at the time, and I think a couple of single families. And he said that he wanted to try to sell a couple of them, but he was having a hard time getting a price. I'm going to have a problem. A lot of that is going on right now again, except that who has the cash, and I'll spill the beans at the end, is going to kind of blow your mind. And we're going to want to pivot to that type of investing sooner rather than later. When you take a look at my dividend stock list, you will notice the company that is at the top of the list. It is a private equity firm. The world is slowly getting eaten, and it's accelerating by private equity. You have heard me talk about some of my private equity investments. And one of the conversations I had yesterday with a couple private equity investors here in Milwaukee that I may or may not be raising money for in the next couple of months, I think I probably will be. I said to them, the reason I sought somebody like you out and found you guys is that I'm a little worried about the way the stock market looks in 10, 15 years, about the time I start to think about retiring. I said, I'm good enough at what I do that if the stock market is similar in 15 years as it is now, I'll be able to generate a huge income in retirement. Now, my concern is that with the private investors, basically the top 1 or 2% of investors, buying almost everything off of the market, off of the exchanges and non-public markets, that I really am not sure what the stock market's going to look like in 15 years. If you're not exploring private equity investing at this point, even if it's by investing in private equity companies that are managed well, and not all of them are, then I think that you are missing what is going on as the public markets shrink. Now, I think there is a solution, and the solution is going to be to put part of Social Security into index funds. And I think at some point, if we do that, that is probably the single best move we can make. And I say that, as some of my friends out in Waukesha County, Wisconsin tell me, as a raging liberal. I'm not really, but they think I am. And I want you to be aware that the public equity markets, while they're not in imminent danger of being destroyed, they are a few waves and maybe a generation away from being so wrecked that they will have to be rescued, not just with quantitative easing, but with major structural reform. And the problem with that is that the group of the richest people who own everything, why would they want to change anything? And they're the ones that can afford to buy the politicians. So think not only about this next cycle, but about 10, probably 15 years out, about what things are going to look like. And I do encourage you, again, if you can, and you have the gumption to own private real estate assets, I think owning real estate, not in REITs because there's a big haircut there, but in limited partnerships where you can trust the people and understand the underlying real estate asset or assets, but generally it's best to go with one specific asset and then just have several investments in different assets. I think that might be the safest way to collect the equivalent of a dividend. Now, as long as we can sell options in a somewhat or semi-volatile market, we will be okay. But I am afraid that in my lifetime, in my working lifetime potentially, probably in retirement, we're going to see a depression. And it might not be necessarily an economic depression, but it might look that way in the stock market, a 10 to 15 year period where there are no gains. There's a possibility that just started. I don't think so. I think there's one or two more effective, if not, they'll be less effective by magnitude, but there'll still be effective quantitative easing pumps of the stock market. But eventually the debt situation is like a mortgage. If you mortgage your property at 125% and it stops appreciating, you got a problem. It takes a long time to pay it off. The way the negotiations are going in Congress right now over the budget bill, and I know the people who voted for this administration call themselves Republican and talk about being concerned about the deficit, and I would call on them and you to challenge your congressman about the deficit, because what they're negotiating right now would generate the biggest deficit in history by far. And the things that they are looking at doing will not pay for themselves, and in fact will create the biggest jump in debt ever, and that includes COVID. So you need to get off of, and I was talking about this on the last call, the rhetoric and the ideology, and do the freaking math. Because what's in Congress right now would crush people who make 5-figure incomes. Crush them. Crush them. If you're not in the 10-ish% of people who make a 6-figure income, you're going to be in trouble. I am literally talking about a decrease in the standard of living over the next 5 years or so for 90% of the population. When is it a depression? It's when you lose your job, right? Some old jokes about that. The difference between a recession and a depression is when you lose your job. The neighbor loses his job, it's a recession. You lose your job, it's a depression. I don't know if the demographics will allow unemployment to jump too high, too fast. But if I'm right, and I'm going to say something that sounds arrogant, but trust me when I say it took me 25 years to come to this conclusion to the point where I could accept it and say it out loud. I'm a pretty zucking good economist. I think there's probably a double dip recession setting up soon, mild, and later, maybe during this administration, maybe shortly thereafter, that is worse. Unless they really change course, which is a possibility because they'll just claim victory on deals that aren't really deals. And they'll say, look, we cut a deal. And nobody's going to understand what the deal was. And they're just going to say it was great and it was terrific. Kind of like, what's her name? Bondi.
Bondi.
Yeah. That the 21 million fentanyl pills that they intercepted, which is just kind of on par with normal, saved 281 million lives or something. They saved everybody's life in America last week. So the exaggerations and the rhetoric that I hear on the economics and the misdirection, and once again, I really recommend that you fire up the movie Swordfish this week. John Travolta, Halle Berry, and pay attention to the theme, not just Halle Berry. The misdirection that is going on right now in the government is the biggest that I've ever seen. It's the biggest I've ever read about. And if my fears are correct, we are seeing the big skim, which is, was going to be a series of articles I was going to write about smaller stuff. But, that CNBC show, American Greed or whatever it is, where they just feature people stealing all kinds of money through Ponzi schemes or whatever. I think that's what is going on right now in America. I think that the insider trading that's gone on, which has been very evident, all the evidence points to it. The crypto shenanigans that are going on, the Trump coin thing. Read about what Trump coin really is. It's basically a mechanism for bribing the president. And you will find out if you're willing to read what's going on, if you're willing to not just rationalize ideology or rhetoric, if you're willing to get into the data and the reality of the way things are moving, if you're willing to do that. Most people aren't. But if you're willing to do it, to be honest, you're going to go, this really seems like crony capitalism at its worst and government corruption far worse than Watergate. I have tried to hold my tongue on President Trump for years now, because of my position and because of my job. Because I don't want him to retaliate against me because I have a super minor internet fame, right? I'm like a speck on the internet, but still a speck. I think you need to understand the risk that we run if we don't reverse course quickly. What could happen? I'm at the wrong slide, but we can start with this. Government debt is going up dramatically. And this isn't all Trump's fault, right? Biden, everybody's had a role in this. Trump went up debt went up a tremendous amount under Trump the first term. COVID, it went up under both of them. It started to level out a little bit and jumping back up. But this is really the product of 44 years of tax cuts that flow about 80% to the richest 1%. That's one of the data points that you can look up. You can ask an AI. What percentage of the tax cuts since Ronald Reagan have gone to the richest 1 or 2% of the population? It's about 80%. In this century, since George W. Bush, the United States debt has gone up more than the amount of our GDP has gone up. So we've taken on more debt than the amount of GDP that has increased. So for every dollar in GDP increase, we borrowed more than $1 to make that dollar. It's like me saying to you, hey, loan me $10, I'll give you 8 in return. Basically what's been going on. And the increase in U.S. debt since 1982 to today correlates 100% to the increase in wealth of the 1% of richest people. So the increase in wealth of the richest 1% of the people is correlated 100% to the increase of U.S. debt. Do you understand what that means? All debt taken in the United States of America since Ronald Reagan has flowed to the richest 1% of the people. That's reality. So when we talk about debt, understand where it flows to. Let's back up a little bit. Nobody's talked about the commercial real estate crisis lately because the banks have been stretching it out. I've told you about all the different foreclosures I'm seeing on commercial buildings. Look at this. We have as many commercial real estate defaults going on right now. It dropped for a while, and now it's spiking back up, as we did during the financial crisis of 2008, 9, 10. These resets are still coming into higher interest rates than when the loans were issued, and the buildings aren't worth as much. So the reason I'm short the regional banks is because they hold so much of this debt, and they don't have the cover from the Federal Reserve and the federal government that the big banks do. And they don't have the tier one assets.
And no FDI insurance either.
Well, these loans don't have FDIC insurance. Those banks do. So the deposits are probably fine. But these banks, their stocks, they're going to have to cut dividends, a lot of these banks, or stop buybacks, or just report zero earnings for a while, or negative earnings. Yeah. Somebody just mentioned that Bank of the Ozarks ate a big commercial loan in Chicago this week. You can go on to Business Journal in your city or the Wall Street Journal, and you can see these commercial real estate loans going bad. If you have access to professional data, you can see this stuff. The regional banks are going to have a headache, so they're going to have a hard time participating in the U.S. Treasury market. Keep that in the back of your mind. Corporate America has a massive amount of debt coming due right now, and it's at higher interest rates for the renewals than what they had 5 years ago. Why is that important? Well, it's in my list of reasons to sell stock. Corporate debt resets will impact earnings margins in the next year. So you're going to see margins and earnings come down, not just because of revenue issues that we're seeing, but because the strength of their balance sheets is going to get weaker. So we have commercial real estate and regional banks. We have corporations. And then we have this entity called the U.S. government. And there's a bunch of signs to watch for, which I've been going through. I show you this article because you should pull it up, right? It's about a month-old article. And they tell you the things to watch for, and they're all happening. I've mentioned the basis trade to you before. This is the hedge funds that were operating in the treasury market in place of the banks that kind of started to disappear 4 or 5 years ago, right? The banking system used to buy all kinds of treasuries, and because of COVID and interest rates going up, they all kind of got burned and they backed off. They added money to their tier one capital. That's why the big banks are okay. Not great, but okay. They can weather a storm. You're not going to see another Lehman, but the regional banks, we're going to see another SVB. We're going to see another First Republic. We're going to see another sovereign soon, this year or next year. But the hedge funds aren't able to make this trade profitable anymore, or not as profitable as in the past, so they're backing up. So that means that you have banks less involved in the treasury market. You have hedge funds less involved in the treasury market, and you have foreign holders of U.S. debt suddenly less interested. Now, this is mostly China, but now we're starting to see other countries back off on buying U.S. debt. I told you about the 5-year treasury auction a couple of weeks ago where foreign demand dropped 8 or 9%. It's a big deal when they're a quarter of your debt. Headline after headline. If you're reading the Wall Street Journal or Bloomberg, you're seeing, and it's not falling off a cliff, it's just a little less demand for U.S. Treasury debt is happening all over the world. Now, I'll tell you, this is one of the reasons the value of the dollar has been coming off, and you need to understand that as the dollar comes down, inflation goes up because the dollar buys less if it's worth less money, correct? A weaker dollar is bad for almost everybody. Some exporting companies it'll be good for, but nobody else. Some investors that know how to play the game. Japan, one of our closest allies. We've managed to piss them off too. Let's go back. Econ 101. What happens when the supply of something falls, meaning foreign money coming into our treasuries? Price goes up, right? This is where we are. This is where we're headed. And now with them blowing out the debt, at least that's what it looks like is going to happen, price goes up again. So the cost of our debt is about to go up. It's already likely. Now, People go, yeah, well, if the Fed just lowered interest rates, then that wouldn't happen. It's not true. It's still a supply and demand equation. The Fed's not the problem here. We all pick on the Fed. It's kind of a sport for people who don't understand, right? They don't understand something, so they pick on it. It's kind of like a human trait, right? It's something that we do all the time. Pick on things, criticize things, fear things that we don't understand. Given that education is headed south in the last generation, going to get more of that. Now that everybody has a mouthpiece on social media, can say whatever they want, and the most outrageous thing gets the most clicks, most likes, most pennies on, the people who get compensated. They say outrageous things, stir up emotions. I liked it better when everything was just about sex, right? Sell it with sex. Now we sell it with anger and outrage and bullshit. Can't we just go back to selling it with sex? That was so much better. I think sex was a lot safer. I know that's not the Puritan thing to say, but I think it's true. So we're about to have debt cost a lot more money. But Scott Bessent says we have the toolkit if we need it. What's the toolkit? Think Japan. We have been talking about potential Japanification of the U.S. Treasury market for 20, 30 years. They are telling you right now they don't care about any of this other stuff I talked about because they are just going to buy all the debt through the Federal Reserve, quantitative easing next year when Trump hires his own guy, will bail them out. So the bad behavior now, which is allowing a massive theft and privatization of assets in the United States, they're going to print money, buy up the debt, expand the Fed balance sheet by $5 to $10 trillion the first time and then more the next time. And what do we get as citizens? A weaker dollar and what? Inflation. So I'll ask you, if you're a Republican and you were pissed off about inflation, that was one of the reasons you voted for Trump, how do you feel about it happening again? Should you not be calling your congressman and saying, hey, man, I didn't vote for Trump to have a rerun of 2021 and 2022 with all that inflation, right? So the first thing you're going to see is the pressure of recession. That's what's going on right now. Oil demand has fallen because there's less travel. Saudi Arabia is flooding the market with oil because they want to crush competition one last time. People laugh because they go, oh, look, gas is $2. It's not happening. Yeah, well, pull your head out of your ass. That's phase one, is the recession. And when they print money, then it goes the other direction. And by the way, if you've been paying attention to what's happening in the Middle East right now, you know that the risk of disruptions is pretty high. And I think it's easy to read into this that one of the reasons that Saudi Arabia is going to create more oil supply is that they know that one of two things happens. Either they crush the cheaters and they crush some competition, or there's an attack on Iran and they make all kinds of money on that. Saudi Arabia is in a no-lose situation right now. We're not. There's empirical evidence that a lower dollar does not increase exports by any marginal amount, right? Any meaningful amount, because other things go down. We've been through this 4 other times since the 80s. This isn't new. It's just bigger. It's huge. And if you're not afraid of what's going on right now, then you'll never be afraid of anything because you just don't have the capacity to understand how incredibly dangerous it is what we're doing. Now, as I say that, I will point out, I don't think anybody in that administration is dumb. I just think they have motivations that they're not entirely sharing. I think it's misdirection. You can't get to those positions and be dumb. You really can't. You can get there and be corrupt or greedy, but get it out of your head that the president or Scott Bessent or Navarro or Miller or Lutnick or Chairman Powell, none of them are dumb. You got into a room with any one of them, they'd make your head spin how smart they are. So that begs the question, why are they doing what they're doing? But I think it's important that you understand how the economic cycles work, how the system works, why things get done. You need to follow the money. So if everything is as fragile as I say it is, and I can be wrong, I reserve that right. I don't usually have to play that card. I've been wrong a few times, never very wrong. Timing is usually the issue. If things are as fragile as I say they are, I want you to see what can happen. So over at Fundamental Trends, Shooter put some charts up. So here is Treasury. Shooter, are you there?
Yep.
If interest rates rise, what can happen to this Treasury
Interest rates rise, we should push back towards 115.
No. If interest rates fall, we go up to 115. If interest rates rise, Stanley Druckenmiller is correct, then we retest this. So right now, your chart says the market presumes that interest rates will fall. Interest rates go down, bond prices go up. Interest rates go up, bond prices go down. So this chart, which recognizes what the market thinks that interest rates are going to come down, which is why you're showing a potential rally up here, correct? Because technical analysis is the market's view of what's going on. It's the sentiment of the market based on what the market thinks. So the market thinks interest rates are going to go down, which is why, and if it's right, then we're going to get a hell of a rally in TLT. Stanley Druckenmiller thinks that interest rates go up one more time before they come down. So if interest rates go up and TLT
We'll put it in a new low.
declines, it'll put in a new low, which we talked about a while back, and that'd be down in here or potentially down in here, correct?
Correct. Well, test $70.
Test $70, right?
We get, I don't know, 150, 200 basis points. I think that'll get us down there.
Okay. So what I'm describing, folks, is called an alternative count. So the count right now, which is what Shooter is showing, is that interest rates come down and TLT rallies. And that very well could happen. But if all these things that I just showed you a second ago manifest in the higher rates because supply shrinks and demand rises, right? If interest rates go up, right, the price of the bond goes up. Interest rates go up, price of the bond goes down, the expense goes up. So if we get down in here, where's TLT again? Did I move it? I lose my TLT.
There.
There we go. So this is the case right now. This is what the market thinks is going to happen. And again, it might. What I'm telling you, though, is that if interest rates go up because the supply and demand equation is, in fact, out of whack and they can't do QE fast enough or they don't do QE right away, then it's going to come down here. And the reason I'm talking about this is because people ask me, should I buy TLT? They say, I think I'm going to buy TLT. All I want you to understand is, A, there's not a big gain to be made in the first place unless things crash in the stock market, which could happen. But the time lag between them lowering interest rates by just having the Fed buy all the bonds could be a while. It could be until next summer, because that's when the new Fed chairman is going to be in.
And we have one flat in TLT that lasted nearly 7 years.
Oh, yeah. So you're saying that, yes, we could get choppiness for a while, is what you're saying.
Yes.
Yeah. So while this is the primary count, I don't think it's very strong. Would you agree with that, Shooter? It's not a very strong primary count.
No, it's extremely weak at this point. And anytime we get what's referred to as a wave intersection, it's like where wave one ends and wave two begins. It's always a crossroads. So now we want to look at conditions of what would cause that change from a technical standpoint, aka Elliott wave. So from our point 2 down around 90.51 on that low side, or excuse me, 80.51, to our primary wave 2, which is our low around 85, you can just draw a trend support line there. And when that breaks, now you can bring in Fibonacci levels and measure it. And it's going to go somewhere between the 382 fib extension and the 78.6 fib extension on drive 1, which I refer to as my golden box. Now, so we can always get an extension from there with market conditions once those conditions are met.
Right. Perfect. So the point I want to make to folks is I think we get to here eventually, right? I think that one's going to happen no matter what. I don't know if this happens. That implies near zero interest rates, but this happens for sure. It's a question of when. And the question is, do we get below this green line first? So if you are the type of person who's like, hey, I can buy in the 80s and I'm going to get 130 someday. If that's cool for you, then that's fine. Go ahead and start scaling in. Again, I never think this is going to be a giant position because it's bonds. I'm an 80% stock guy, in general.
Heck, you could just buy commons and sell covered calls and probably do well with that. That should earn you about 15 points, I would think.
Right. We make double digit returns on the covered calls and the cash secured puts every year. So this is really what I've called it over and over again, recession insurance. But the velocity that is manifesting right now, the speed at which things are happening is sometimes super fast and sometimes just chop. And we don't know. So when people ask me about should I invest in TLT, my reply would be, how much do you want recession insurance? Number one. And number two, the interest rate on TLT is not much more than the money market rate. And by going out to the 20 plus year treasuries, you're taking risk. So if all of a sudden this goes down here, I mean, you can lose 10, 15%, maybe 20% if interest rates spike up. Do you want to take that risk? That's a question for you, not me. I'm not doing it.
I think there are better places to be, even though I'm holding 93 calls right now.
Right. Somebody just said it would be a repeat of 2020, 21, right? When interest rates went up. So I just want you to understand, I'm not a big TLT guy anyway. I've only bought it a couple times in my career. I did buy it in early 2008. That paid off. But if we have a debt crisis that drives interest rates up for a little while before we spray paint the world in money, then this is going to go way down.
How big is $80 billion in treasury?
80 billion or trillion? Oh, 80 billion?
Yeah.
Not that much, right? It used to be a million here, a million there. You start talking about real money. Now it's a billion here, a billion there. Now it's 100 billion here and 100 billion there, right?
Yeah.
And we're talking in trillions now. So I would say that, and I understand what you're getting at. The way this can spiral.
Well, we have a headwind, right? And the stablecoin market is growing, and the stablecoin market is guaranteed by short-term treasuries, which is also why we're seeing the drain on the bank. However, the dynamics of that, and the reason I bring that subject up is because you might be a better person to help give me a better visual of the dynamics of that, because I'm still reaching for how those dynamics will actually manifest. And right now we have a number of about 80 billion, and it's grown by about 10% in less than 6 months.
So at the end of 2022, when I told, so at the end of 2021, start of 2022, when Bitcoin was around 50, 60,000, I told everybody it would go under 20 and they laughed at me. At the end of 2022, when everybody was despondent and was thinking, oh, Bitcoin is in the teens, it's going to go down to 5,000 again, I said, no, start buying it. And one of the things that we talked about back then was that eventually, and it didn't happen under Biden, and we know it wouldn't happen under Biden, eventually stable coins would basically become like money market accounts. And one of our thesis back then, and it's good to revisit it now, I'm glad you brought it up, is that eventually stable coins will become a demand driver for U.S. treasuries and really the notes, right? The short-term stuff. So that's starting to happen. It's growing at, you said, what, 10% every 3 to 6 months?
Yep.
I think that's probably going to accelerate, actually. So we are going to see the short end come down almost regardless of what the Fed does. The Fed's just going to have to keep up. It's the quantitative easing that's going to bail out the long end of the curve whenever that happens. I think it happens next year. Maybe the shit hits the fan this year and Powell capitulates and he does quantitative easing because there's a bill passed that tells him to do it. And that's what happened during COVID. There was a bill passed, right? I mean, he didn't just come out and say, I'm doing quantitative easing. Congress said, this is what's going to happen. You're going to cooperate with the Treasury and this is what you're going to do. And that's why somebody on Twitter, X, said that the Fed chairman can't just do what he wants. And I said, yeah, actually he can. He only needs one or two allies. Do you know who they are? Well, the allies are Congress and the president. And then they just use the tools at the New York Fed to execute it. That's what they did during COVID. I think that's what's going to happen again. I think
should we be visiting short-term treasuries? Is that going to continue to expand in price like we've been seeing?
Who cares? It's not enough. If those do well and they bail out the long end of the curve, the money to be made next year, presuming we don't lose our ass this year, is going to be in equities and Bitcoin, right? I mean, why screw around with bonds when you can 5 and 10 exit in equities and Bitcoin? I mean, what happens to Bitcoin if they print $10 trillion again?
Unbelievable. I think my numbers will be shallow.
Well, I kept saying, anybody remember? What's the number that I said Bitcoin's going to go to no matter what? My back of the napkin says this is the minimum price it goes to eventually. Now, I did think it would pull back to 50 or 60 first. Eric's got it. Yeah, I said 300,000 2 years ago. Yeah, everybody knows. See, everybody's 300,000. Everybody said the same thing. Okay, I must have said it more than once. Bitcoin's going to 300,000. Now, we don't have a chart for that today because I didn't pull it up. But Bitcoin can still correct down into the 50s, 60s, or 70s on this short-term stuff that's driving the price of oil down, which usually leads to recession. So when the liquidity drains out of the system, because everybody is panicking and trying to pay their bills, everything goes down. All risk assets go down. You get deflation for a minute, a quarter. Bitcoin, the COVID crash was super fast, but the financial crisis took about a year. Now we had a year of warm up and then a year of it. So that, I mean, from the Bear Stearns funds collapsing in early 2007 to the end of the bear market in March of 2009, it was a little over 2 years.
Yeah, we actually saw it starting in 2002 with underwriting guidelines.
Yeah, and that was still part of the bubble blowing. So one of the things I want to prepare you for, and I'll talk more about it in coming months, is that when there's a bubble, and this is not something I'm making up, this is something that I heard from a pretty rich dude, Paul Tudor Jones. He said, hell, it's a bubble. I'm getting my ass in. I'm going to ride that sucker up. You got to have an exit strategy, though, right? You do not want to be the last person to get out. So I think that we're at risk of retesting the 2022 lows on SPY. So let me see if I can get this just right. There we go. Tell me about your SPY chart, Shooter.
That's not SPY though, is it?
I think so. Oh, that one's $1. There's SPY. There we go. We're gonna skip over the dollar. I don't really care right now.
That's
the
right.
dollar gets stronger, everything goes down. How's that?
Yeah, the numbers here, I mean, if that 4 is done, right now, we are less, as this rally continues, it's looking more and more like an impulse wave down. So what we see is drive 1 and drive 2 is not completed yet. And that would extend this down to really our demand zone between 348 and 339, which is not reflective on that chart at the moment because that's not the cap. Right now, the system still sees that 468, even with this bounce, which in itself is telling.
Yeah. So do you remember 2009? Were you trading back then?
Just little, I'm mostly just LNG at that point.
Okay. So in 2008 and 9, this process, if you go back and look at those charts, it did that 9 times. Is that an Elliott wave thing? 3 waves down 3 times?
It becomes more of a flat. You still have an impulse with a flat, or what's referred to as a fading flat.
All right. I heard another Elliott wave guy describe it as something theoretical, but
yeah,
during
there are 3 5s and 8s though. So I mean, technically you could get 8 legs to an impulse.
Okay. So for this to get down to here, does it have to have more than ABC?
Well,
or could we be an A, B, and C?
At this point, structurally, it would be an impulse leg down, most likely a leading diagonal from the breadth of what is already forming in wave 2.
Okay.
There's a symmetrical number with fibs. We haven't quite exceeded the variance, but we're like within 6% of that variance on wave 2 at this point. Once that 6% is gone, then the ending result is this is a leading diagonal and there are no other technical options. So
this chart is very likely to change and reflect a lower downside at sometime soon. Okay. I agree with that. So my base case is a price somewhere between here and here. But if the credit market breaks, I'm not saying it will, I'm just saying it's possible, more possible than normal. If the credit market breaks, we could see prices way down here. I mean, we could see worse than the COVID bottom. I don't think that's likely, but it's more possible than I want to think that it is. It's more possible than I want it to be, right? So this area down here seems to me like where they just print. I called over here QE infinity. I thought this was QE infinity. I think that I'm going to be outdone. I think that we're going to get what's more than infinity. I think we're going to get more than infinity the next time they do it. It's just how much more.
Well, they won't have any choice.
I don't think they will.
Yeah, it's going to pop so bad that they're just going to be buying everything and moving capital into everything to just try and stimulate everything because everybody's freaked out.
Right. So I'll tell people what I'm doing with my money, and you can apply it to yourself the way you want to. I am putting myself in a position to have as much liquidity available as possible after Labor Day, because if we get a credit crisis or real estate temporarily drops 20 or 30%, I want to buy real estate, because as a store of value, and I have some value to store finally, as a store of value, you really can't beat real estate. And you don't want to buy slums for the little bit of rent. You want to buy the very best quality real estate you can, preferably at the edge of an area that's starting to get developed. That's what I'm looking for. I've told you that I've started to have conversations again about buying that golf course that I missed out on a few years ago that came up for sale again. It's in a suburb of Milwaukee that is incredibly desirable, but the suburb hasn't managed their finances well. They haven't developed the way they should. And now all the forces of the municipality need money, the land being there, interest rates being high, so not a lot of bidders, and us having maybe the cash to just go on and scoop it up. And we might get that opportunity. We might win. Again, I encourage you, if you have younger people in your family, open the conversation about buying real estate with them. Don't wait to die to help people. I know that some of you have to just take care of yourself, but I also know that some of you have a few extra ducats. So whether it's for you or with family or kind of horse piece, if you get an opportunity in the next year to buy real estate, think about what happened during COVID. Prices plunged, and then they came roaring back a year later. You're going to have a minute to go out and buy real estate. So prepare for that opportunity now, because if you get it, you're going to want to take it. Whether it's a second property for yourself, a vacation property, an investment property, a hunk of land that's going to develop at some point, whatever. You buy 35 acres of agricultural land and put a corn stand on it. Have some fun with it until somebody buys it from you to put 60 houses on it.
Yeah, you can now hold stablecoin as backing for a credit line now.
Yeah, I would. I'm a cash is king kind of guy. I think the crypto markets have a lot more gyrations coming, both positive and negative. I'll lay that out. I'll lay that thesis out as it develops, but I don't think crypto is a sure thing. I think that it's going to be a boom and bust sort of thing for a while until we know what the governments in a decade really allow. I mean, it's one thing what they're doing now, the way the social structure develops, and the way voting goes, and the way the politicians go back and forth, the way the populism shifts. We don't really know what crypto is going to be in 10 or 20 years. We can say, I think, that we're going to get some spikes and crashes. And the next thing is probably the finishing up of a correction and then a spike. That'd be my guess. Maybe the correction's over in crypto already. I don't think so, but
It's acting like it is.
We'll see. There's a lot of traders' narratives out there, and the one thing that I've learned in 30 years of doing this is that when the traders are all running in one direction, it's a sprint. Well, I'll tell you what.
More money selling at the exit.
Well, right. I mean, think about a sprinter versus some dude from Kenya running a marathon. Yeah, the sprinter is going to get out in front of him, but at about 3/4 of a mile, the Kenyan passes him and fucking blows him away, right? The sprinter never catches up again. So while the sprinter can get out ahead, you don't know that it'll last. Again, just always remember that the richest people in the world are not short-term traders. They are cyclical position traders that buy bottoms and sell tops after long rallies with all these wiggles in between, right? The Paul Tudor Jones of the world, buy down here, sell up here, take a vacation, buy down here, sell up here, maybe short, take a vacation, buy down here. That's how I've made my money. Now, between here and here, I might not make as much as Shooter because he's making money every gosh darn time. But when I buy down here and sell up here and take some premium along the way, I do pretty good because I avoid these. That's what I'm good at. Now, once we get to here, you have to decide who you are and do you want to trade these? I usually don't because I'm not good enough at it. Even copying Shooter, I'm not good enough at it. But again, there are people in that chat room with him that are putting the 15 hours a weekend and they're killing it. I mean, Rick, I don't know if Rick is on here, but Rick, if you were willing to say about what was your return over the last year? I know he did well. I made over 100%. So if you are willing to put in the work to trade with Shooter, you'll beat me from here to here. I know that I've given a couple trades in the rare chat room recently. I talked about buying volatility and selling volatility. I said buy volatility up here, sell volatility down here. It would have been a great trade for the people who took it. I didn't do it, again, because I manage other people's money and I can't do things like that without getting in trouble. I'm okay if I'm right, but if I'm wrong, I'm in trouble. So I don't do it. That's the nature of being regulated. Now here, Shooter, how close are we to needing to really cut risk again? Like within days?
That's a great question. RSI is not giving me any signs that the top's in, so I think we push towards that 78.6. I think is the most likely outcome up there.
Yeah. So I had my marker right there. Huh. Yeah. I can read the chart too. Yeah.
You can tell when I take, I start putting my toe in the water, and right now I have no alerts on what I refer to as my quarterly, my monthly, or my weekly strategies that I've written around Elliott Wave. I have no alerts to the short side. Everything is firing on the long side, and it's been very challenging the last 6 or 8 weeks, because if I was not as successful as I had been the first quarter of this year, I would have put on a lot more trades. And so we have a lot of stuff that's set up really nice going into the FOMC. And I would suspect that that continues unless we have something that is catastrophic towards earnings or jobs or something, because those have to roll over. However, there is some weakness to the short side. So that might be where our strength is. Maybe, I don't think shipping has gotten hit yet fully. I don't think trucking has gotten hit fully yet. So I think there's a potential that we could sort of go off on a side road and trade those short, still keep our exposure to a decent number, much like we did when we saw the pump coming into emerging markets. We pretty much caught the bottom on that. And I would say that we're probably 60, 90 days out before trucking, freight, and all of those infrastructure plays really get clobbered, because right now it's not showing in this quarter's earnings yet.
Yeah. So what you just said, I think, is spot on. Most of the leading indicators are saying we're 1 to 2 months from getting whacked. So that gives the administration some time to make some changes. The problem is, does the rest of the world even care what the administration does at this point? Right? So yeah, so the argument I've made in this article is that basically retail is buying while the professionals are selling. That usually doesn't work out well for retail after a quarter or two. So I think we're closing in on getting whacked. I know what chart I'm on, this one. I think we're going to get whacked. I think this is the best we can hope for.
I agree.
And I think that this is
more and more likely.
Yeah, I agree. All right, Teresa, you get to close the show.
Oh, that's exciting.
All right. I got your QQQ chart up here.
Last.
Yeah. Tell me what you're thinking with this, with QQQ, because realistically, these are the best companies in the market for the most part. I mean, there's a handful of exceptions of S&P stocks that aren't in QQQ, but the QQQ stocks hold something like 80% of all the cash on corporate balance sheets. So they're very strong companies. And if Amazon and Google get broken up, they're just going to spit out great companies. So tell us about QQQ, what you're seeing, and then maybe we talk about some of the underlying companies' influence, some of those Magnificent Seven.
So I see, we had that April, so that green candle that's, you see that's got that really long tail. That's coming back in April. And that whole chart just looks like it's dangling to me. I think that price wants to go up. It wants to hit those sellers. And I think it just wants to drop down to where those buyers are at. And maybe it'll go on and make an all-time high. That's kind of hard to believe, but I just think it's dangling and it wants to go down. It hasn't found enough buyers yet to send it over the finish line. It just hasn't done it yet. Not gonna, and we still have the monthly uptrend is still intact. And so if we break that, obviously that has ramifications, but we can go clear down to that rectangle I've got drawn that shows buyers and still be in the monthly uptrend.
Right. So this is a monthly chart.
Yep.
And you brought it back to the second half of 2018.
No.
Where on December 24th, the market bottomed. And we've
Yep.
basically been in an uptrend ever since December 24th of 2018, right? And it kind of bent up.
Yeah.
I would argue that a lot of the bending up has to do with all the QE and the M2 overhang, the money supply overhang, which is drying up and running into credit issues. So if this comes down, this first zone represents the mini correction in the middle of 2023. We don't have your volume bars up here, but does this seem likely to hold to you, or do you think this one's more likely?
I think that, well, I mean, does that monthly uptrend want to stay intact? I suspect it's going to want to. So that makes that first box.
So 360, 70, 360, 70.
Yeah. But the only thing, okay, so the uptrend could stay intact if price zips down, grabs that lower box, and then heads back up again quickly. Kind of like having a tail like we saw in April.
Okay.
So,
Shooter, you got any thoughts on that?
It's just as deep, if not deeper, than the SPY on the impulse leg down. Right now I see a number that we probably could push back in a 5-wave up to about 503. However, I do have a cycle wave 3 that's up there around 560, which could manifest. But on the shorter term time frame, I think we have to look to someone like Google, and how much we rolled over here. Again, I think Amazon is going to be a huge factor here, and Apple is a huge factor. Reason being is, if we can't import the goods that Amazon sells, how much of a haircut are they going to take? And then 2, how much, we've already lost, 7 or 8% in Apple sales in China. How much of a haircut is that going to take? And then how much does that spook the Mag 7 to the downside? I think is going to be the lead factor. That's my 2 cents there.
Yeah. I'm going to go back to a long time ago. Give me 10 seconds. So my question is, does this look like it could be a giant head and shoulders view? And I just want people to think about the times that this market's been super overbought. And since the QE age began, it stays overbought for longer and goes higher. So this actually represents a 4th standard deviation. I've never seen that before. So that's overvaluation that's way outside the normal range. If we go all the way back to really when they got into QE 2 and 3, you see that this uptrend is pretty pronounced, right? So here's the AI is telling us that this is the uptrend. We are just about to break the midpoint if it drops again, which probably takes it to here. And then you generally expect a rebound rally. And then the question you have to ask is, does it get down to here? So this happens to jive with right where Teresa said, right? 370-ish. My chart says the same thing, rebound. Then by the end of the year, we're down to around 300 on QQQ. Now, again, policy can change. We can somehow find a way to bail out the credit markets. I had that expanded for a while. Does it only get to here, right? Does it go like this, then stop, maintain the uptrend and start moving up again? Or does it get down here, rebound, and take another digger, right? And go 1, 2, 3, 4, 5. Because that's one of the Elliott wave potential things, right, Shooter?
Yeah.
So I think it's going to be 1, 2, 3, 4, 5.
If it's a 5, you're looking at 217.
So that can extend all the way down here into the Jeremy Grantham zone.
Yep.
Yeah. I really hope that doesn't happen for other people. Now, for me, I'd be okay with it because I'd probably make a screaming fortune.
We won't miss that.
It would be so bad for society.
Yeah.
Right?
Oh, we won't miss that. I mean, one reason I'm holding a piece in 400 puts right now is because when it rolls over this next time, if we get it, it will be fast.
Yeah.
You can take the congestion from our peak, which was, what was that? February, to our next trough, which occurred in April. So less than 60 days. We've now pushed our next rally, which is the end of April. Notice how that it'll accelerate to the downside. So we will put in our 3, June, July, August, maybe if that. It'll be that quick.
Wow. Okay. Yeah, well, we'll see. So, folks, just understand the charts are a manifestation of collective sentiment and what the market expects. It changes though. Sentiment changes. The article that I'm writing is called Liquidity Speaks, Sentiment Listens. You know who that's a play on. I'm making fun of him. And now that he's not on the platform, I can do it more. But and I respect the guy, but it's fun to make fun of people you respect. If liquidity changes for the negative, then all these more negative scenarios will play out. And I just want people to understand it can happen. So when I think about investing, I am real cognizant of avoiding the middle of the market because you don't know if it's going to go up or down from there. I really want to see what happens with the fundamentals and the macro. If the market deteriorates, if the fundamentals and the macro get changed by policy or big money or international players, is there something that makes it better? If not, and I suspect that at least this year it's going to be if not, things will play out to the more negative scenarios. So you have to think about what is your real risk tolerance. I've had a number of clients tell me, Kirk, I don't care if you're behind a little bit, if it goes up, but I can't stomach losing 30%. So I'm real conservative for those clients. And you have to think about your risk tolerance because the money supply that pushed the market up the last couple of years is just about exhausted. And now suddenly, rather than leveling off, it's actually reversing quickly because of the tariff war. It would have chopped sideways, right? So if Kamala had won, we were going to have all these debt problems anyway because they were already there. But she would have handled it. She would have stretched it out, tried to smooth it out, right? She would have done the Biden thing. Just try to build and grind your way through it. Trump's like, screw it. It's bad. Let's try shock therapy. Now, some of the things Trump is doing, I'm actually in agreement with the theory. I don't know if the execution is great, but there are certain things we definitely had to fix. But then on the other side of the equation, right? Besant today talked about, because he was on before the Fed chairman this morning, he said, look, this is all big plan. It's not just one thing here and there. It's all coordinated. My problem with that is I look at the plan as a pretty qualified guy and I say, yeah, that doesn't make sense. Some of the things they're doing doesn't make sense. For example, the whole leaning into Canada and Europe and Japan and South Korea and Vietnam, the reciprocal tariffs on most of these countries did not make sense. They just didn't. Tariffs have always historically been most effective when they're targeted. Blanket stuff has never worked, ever, and arguably was part of the Great Depression. So I take a look at the different pieces, including blowing out the debt, the way that the budget is currently being proposed. And these all pieces that are supposed to work together, it doesn't look like they're going to work to me. I really hope that I'm wrong, that they have a real end game that isn't just taking money for themselves, but my bullshit detector is going off. And my bullshit detector usually keeps me out of trouble. Sometimes I miss a party, but usually it keeps me out of trouble. So if you're concerned about maybe taking a 30% header or worse, then think about the amount of risk you really should be taking and adjust your portfolio accordingly. This rally that we've had is your opportunity to sell covered calls or trim stock positions, primarily S&P 500 correlated things. Your small cap catalyst driven stocks, they're not as correlated to the market as you think. They may be correlated to debt financing. You have to know the company, but they're not generally correlated to the S&P 500. One of the articles that I'm writing right now, and I don't think I have it up. Here, VeriSign. I don't even know if VeriSign is on our very short list. I think it is. But I was refreshing my research because I'm researching companies all the time. And I just decided, well, I have enough notes on this one that I'm going to start writing a quick little article. And there's a lot of good companies out there that fall into this category where they have some strengths. VeriSign is, kind of a monopoly player in .com and .net domains, but they have some weaknesses that have to do with not really having any growth. They have some opportunities, but they're really going to have to execute well. And there's some threats from regulation and competition. They've taken on debt to do buybacks. The debt's becoming more expensive. And technically speaking, the stock is blowing out, right? It had a big rally. I mean, look for this. This is the last week, 2 weeks. Overbought here on RSI, one of the most overbought stocks out there. And I'm seeing more and more charts like this, where they got to the top of the range here and here, And then they had the correction, and now they're getting to the top of the range again, like the S&P 500 and QQQ on their shorter term trends. VeriSign doesn't have hardly any going to zero risk, but they have pretty big going to 200 risk, and they're close to 300. There's over 100. There's over 100 stocks on the S&P 500 like this, closer to 200.
And they have a huge AI catalyst too.
Everybody does. Who's going to execute? Who's going to win? Who's going to actually drive margin? Not many is the answer. So if the AI hype wears off and this company, has a problem because they have to refinance some of the debt at a higher interest rate, or growth goes from 4.7, which is already low, to 4.3, which is possible, actually probable, then this PE ratio is way too high, and then you get a valuation correction. The entire S&P 500 can take a 20 to 30% valuation correction without the companies changing that much. That's the thing, is that this is priced to perfection. Look at this. Look at this. These prices in here. It's telling you that this is around where the price should be, but it's way up here. It's going to come and visit this area again. Now, does it go back up here in a few years? Probably, especially if we get QE. You have to decide how you want to handle these kind of moves over the next few years. If you're listening to me, that means that you're generally willing to trim up here and not be stubborn and say, well, I'm just going to hold it because I made money from here to here, or from here to here, or from here to here, whatever. But there's a lot of stocks in the market that can do this kind of move. 20, 30% down fast. Shooter just told you if it happens, it's going to be fast. And then if we don't get QE for a while, it's going to chop along. So my approach, which doesn't have to be your approach, but my approach has been to cut risk, because I think I'm going to get a redo to buy almost everything cheaper that's in the large cap realm. Small caps, a little different. Mid caps, a little different, right? Again, those are more catalyst driven. They have different drivers. But the large caps, I think 20 to 30% lower across a lot of them. And I don't think it's hard to do, right? This is not really, right? To go from here back to here, does that look like it's a big deal? It's not, right? So it's understand how the mechanics work and decide how you want to handle it, and decide ahead of time. Don't decide, after you see it drop 30%, I'm going to sell it now. What's the point? Now, at best, you're in the middle of the market, and you might be at the bottom. Make your decisions proactively. Think about risk as you manage your money, and understand that if you're locking in any type of double-digit return on an annualized basis, you are beating 90% of the investors out there. That's true. All right, Teresa, Shooter, any exciting things to say on the way out?
Oh, I don't think I have much exciting at all. It's just everything looks sort of like that VeriSign chart, except for those small cap catalyst driven stocks that are sort of beat up.
All right.
Thanks, Kirk.
Everybody
Thank you,
have a
Kirk,
great
Teresa.
night, and manage your risk. That's my takeaway. Manage your risk. We don't know how bad it's going to get, but risk is high.
Agreed.
Good
All right,
night,
folks.
everyone.
Until next time.